Samir Arora is joining us now, founder and fund manager at Helios Capital. Tell us what 2020 taught you. What myths were debunked in 2020, and what's your biggest learning from 2020? We all learn everything. We all learn something.
Yeah, sure. So when we're talking about learning from the market, what we may say we learned is that some of the old thinking has to change, but I'm not sure whether I have learned it that I'm going to permanently change it. But in March or April, when the news came that how the US Federal Reserve is going to, sort of defend the economy and the market, we have always had don't fight, said means read, and then maybe absorbed a little bit that don't fight the Fed and don't find the central bankers. But this went beyond anybody's imagination, at least the imagination at that time that we all had about what the bankers can do, the central bankers. So that itself was a big thing. And then also in the beginning, we always made fun of, oh, this is the retail crowd buying stocks and these guys don't know anything. And in the end, we bought many of the same cloud stocks in US, which had been bought in the beginning more by the retail market than any institutional buying, at least whatever we could read. But from a personal point of view, I think what has happened is that this year, nobody is asking anybody as to what resolutions you will have for this year. Because for me, for example, I always say, I'm going to exercise and I'm going to the gym, and I've been doing that for the last 4 months without any resolution in mind, but just because that is what was one of the things that happened when you were locked down. So all in all, it was a good year from a market and performance point of view, but otherwise, you realize now that traveling is a big part of the lives of many people, and not being able to go to Delhi and all, it irks me a little bit.
Good one. Okay, well, you know what, Samir, we will continue with all these serious questions about, how do you see the trends, how do you fight or ally with the central banks in 2021. But I want to ask you something which we don't often ask you. What are your PMS schemes? How do you design them, and how are you designing it differently for the year ahead?
Also, actually, we didn't have a PMS scheme before.
Okay.
Helios India, we launched a PMS scheme in 2020. Primarily, we had been doing this offshore fund for investing in India, sometime long short throughout, and then for separate accounts, some long only accounts. And then we realized that instead of just investing foreigners' money in India, we raise money from India to invest in India. Our performance is a bit good for the last 15 years. And so we are just going to copy that in India plus minus a little bit. So it is that PMS which has been launched by Helios Capital India. So this PMS is now some 7-8 months old, and it's up nearly 50%. So it's good because it missed the first bad month of March and all, but generally it helps to have a good start. But otherwise, we've been around for 15 years in Helios and 25 throughout. So if you want to read more, you can visit our site there, which is whatever it's called, helioscapital.in. But otherwise, it's the same themes that we like, which is private sector financials, consumer, and tech pharma. Initially, it used to be tech, then over the years, tech pharma. And then you take whatever are the new themes for 15-20% of the portfolio, maybe 2-3% per name. Like we had PLI, 2 stocks, we had some rural play, 1 tractor play that you keep talking about, and some internet type stuff. Basically things which in the beginning we were not sure how far they'll go, and so you buy 2-3% in each. But otherwise the backbone is the 3 themes: financials, the IT as we should call it, and consumer.
Samir, we always talk about stocks, about investments, etc. But as an investor, what is the biggest learning that you had from 2020? I mean, anything that you would take forward into the new year?
See, it's very difficult like that, but it's an accumulation of 20 years of learning or 25 years of learning and reading. So my first thing is that there are different phases in the market at different points of time. So if you were an investor in 2017, you will say that, we should invest in mid-cap stocks because it's the mid-cap stocks which in the end become large-cap stocks, and to identify them early. Then in 17, when the market goes down, not in 17, but in 18, the thing will be we should buy only these large companies because these large companies are taking away 70% of the profits. Then suddenly in between, you'll get a say an ILFS kind scheme, and you will say we should not buy financials because financials are leveraged, and leverage things in the end don't work out. And then somebody will come and say we should buy the lowest quality stocks, and then somebody will say we should buy the highest quality stocks. So the learning, and for me, my big thing in terms of surviving, and not just surviving but flourishing in some sense at least, is because you put everything in limit. There is no one formula. The whole thing that people seem to have learned or badly learned last year is as if there is a formula that you can buy stocks, and those stocks can be up 50%, and those stocks are well known at the beginning of the year, and they will have bad earnings in the current year and maybe normal earnings next year, but it doesn't matter because these things are good. Or you buy completely small IPOs on the basis that one day this IPO will become like my listed company because they are growing faster. It doesn't work like that. Everything has to be a little bit, you have to be a little bit cynical in life to do well, I think, and a little bit diversified. But it's not a new lesson, but it gets reinforced when you see action around you.
Samir, some of these stocks, Jubilant, Foodworks, of course, I'm not even getting into Burger King's listing, but these stocks have done well. And yesterday, Zomato was, owner was tweeting about 4,000 orders per minute. It's a massive market, but you think it's still good at this price?
So we have one of these stocks, but let me give you a big picture, which is going to be a big tougher thing for 2021, is that right now the new businesses that are the disruptors are saying that people will not forget this. So say an food ordering company will say that people have become used to ordering food online and they are willing to pay the commission, and they're even tipping the person who's delivering food. On the other hand, the restaurant guy will say, no, people will come back with a vengeance when the lockdown is lifted. So the theater guy is saying you will never forget going to the movies, and the OTT guy is saying, no, you have learned, not learned, you have subscribed to so many of these OTTs and you have enjoying them. Similarly, in every sector where there is a little bit of a shift, the old guy is saying that it'll come back, and the new guy is saying that you have change your behavior. And right now, every stock is going up, more or less, relative to what is happening in their life. So in the end, this will have to be decided this year. The other thing I feel is that because some of these stocks are up so much, not these kind, but let's say the IT kind or even any auto kind, where you are, because the stocks are up 20, 30, 40% year to date, not from the bottom, you are implicitly assuming that they will have an earnings growth of 15, 20%, otherwise that price was wrong. Then every day to celebrate that they sold 5% more cars or they got a new order, IT order, that is implicit. The fact is initially you started with the consensus that the earnings growth for this company, let's say, is 20%. Almost by definition, then every month, the auto sales number should be X% higher. The order from a foreign company should be so many million to get to that 20% first. So this year, I think it'll be maybe easy to make money, but not easy to outperform, because unless you're on the right side of this, that is it the disruptor or the disruptee, and how much of the day-to-day, because you will see a big order growth, sales growth, restaurant growth, hotel booking growth when these things cool down, but you don't know how much is it discounted. That is going to be a tough thing.
But what is your hunch? Will it be the disruptor or the disrupted that you would rather bet on?
So I don't want to bet on the disrupted because, if the terminal value is a big part of the story. So I am leading this to, say, auto industry, where in the world the industry has been disrupted. Actually, it is over. If you look at market cap point of view, it is over. Because you look at Tesla versus the others, there is no comparison. So what is the point of trying to trade within GM and Ford, or let's say equivalent, because the thing has been disrupted already. But within that disrupted, it's like an SMS versus a WhatsApp, that the SMS has not gone away. So yesterday I was talking to one guy on theater. He said, no, they will coexist. People will keep going to the theaters. I said, obviously, even today, people still use SMS. That does not mean that the SMS has not been disrupted by WhatsApp. Disruption doesn't mean that tomorrow morning you will not see anybody on the road, anywhere near a theater, or anybody buying a IC engine car. But broadly, it has been disrupted, and therefore the force of that It's like, look at the coal. Now, in the world, coal may have been disrupted even by ESG, but not in India. But nobody wants to buy coal in India because the terminal value is in threat. Will it be stranded coal after some time because some Paris Accord will come, some God knows what will come, and even though you have it and you can use it, either the world will not allow it, or even if it is allowed, the stock market will say, I don't go for businesses which don't have terminal value. So I don't want to go for disrupted because the whole point is that there are so many companies that do well. Everybody agrees that a large number of companies do well, including the guys who say we want concentrated portfolios. Because even people who buy concentrated portfolios, they normally have 3-4 funds, each of them with concentrated portfolios. So in the end, they all own 40-50 stocks.
Yeah, you know, Samir, you're driving to the question that was on my mind. Why did you launch the PMS now? Are you noticing a kind of weariness with mutual funds in India and people, you know, wanting, you can do an ETF or you can do one of those index funds and give the remaining to people who are going to use their alpha, the PMS guys. Is that trend catching on?
No, the thing is that the mutual fund, I had no idea before. Because we were anyway doing this, we just thought that India market as a market to raise money is good. But then we started analyzing that what is the mutual fund performance, just because people ask this question to our guys in India. They ask me, how should we answer questions on mutual fund versus PMS and stuff like that. So if I found a magazine article, Outlook Business from 2020 February. So it says that there are only 5 fund managers in the entire mutual fund industry who outperformed the market over the past 5 years and over the past 10 years. Only 5. And there are only 30 fund managers with 10-year track record. So for us, there's been no 5-year period in 25 years when we wouldn't have beaten the market. But anyway, we didn't start with that. We started with the idea that India is a big market and we should also target that market for a raise rather than just to invest, and then let our history and performance and all that guide how it goes in future. But generally the mutual fund performance over the last 2-3 years, now that I analyze it more, has been bad. But otherwise it's been quite good. I am from the mutual fund industry and all those. And I think the reason for that is over concentration on a point of view. If you see the biggest fund has done badly because overly committed to economy and PSUs and turnaround. And this for 10 years, if you have that view and it doesn't work, you must have the flexibility in mind. I think the biggest strength in a fund manager is to be totally wrong on the thing in the beginning and then get it right. For example, in 2016 end, I was on CNBC and I remember one line to Anuj, which I won't say right now again, about a demon. Not to him, but I'm saying, the way our country is very sensitive. But we were very negative on demonetization and we had reduced our net to something like 20%. And then 2017 turned out to be a massively great market from the market point of view. And you had to turn maybe by February or something, we turned and caught up and whatever. So the point is you can't go in with a view, I think economy is important, I think this is 2003, I think this year is, because it doesn't work like that.
Okay, that's a lot of lessons you have taught us, knowingly and unknowingly, Samir. Have a great 2021 and
Thank
may
you
you
very
get
much.
to do
Thank you
all
very
those vices that you couldn't do in 2020. Welcome back. It's Outlook 2021 time and we are getting you the best minds from the market, veterans, to tell you what can be the big themes and what are the big learnings from a rather difficult and extremes that we saw in 2020. Joining us now is Ramdev Agarwal, Chairman of Motilal Oswal Financial Services. Good morning, Ramdev. Thank you very much indeed. Have a superb 2021. May it be grand and glorious for you. And for starters, what are the big learnings from 2020?
Let me wish all the viewers of CNBC TV18 a grand year in 2021. So I think we had we had wonderful year in 2020, which is very unusual given the pandemic situation. But we had a wonderful year and a lot of surprises, I would say, which is the nature of the market. It surprises you. I would have not thought in December of January 1st of 2020 that we will have 15% market performance given the COVID kind of a situation. And yet we had 15% index performance in last 1 year. So I think one of the things which I was always practicing and I always believed was that nobody can time the market, and at least I can't do it. So that proved to be absolutely what is called on dot. So buy right, sit tight, whatever you like, whatever you understand. That's the way to go in equity markets, not only in India, all over the world. So we had wonderful time of seeing markets collapsing by 30, 35%, 40%, and all the way come back, and not only come back, but complete new high. So, I mean, in 1 year, you learn so much.
Absolutely. Well, Ramdev, one of the lessons we learned in the previous 6 years is that every time analysts start with a high EPS growth number, and by the end of the year, you trim it down. In 2020, it was the opposite. People have actually upgraded their earnings after a long gap. Now, the number I did a poll and I got for, earnings for FY 21-22 is a solid 30%. I mean, people are approximately 500 rupees this year's Nifty EPS. Next year, the average I've got is 660, which is like some 30% growth. You think that this time around it can be different? We will do that kind of an earnings growth?
Earnings growth will come because this number, what you're talking about, 30-35% growth, is made up of 2-3 very large unusual items which were there in 2020. One is, of course, all the banking losses because of COVID provisions. That will not be there, hopefully. And second is the telecom losses, which the Airtels of the world, they booked in last year. So that will also not be there. So because of all this, 21-22 could be a very good year. And in any case, for last, I think 4 or 5 years, we're stuck at about this 450 to 500 kind of a situation. So it's a long overdue for a takeoff. A lot depends on how government's effort is post-COVID, the build-up of the nation and the budget and the spending in the economy to come back. That will be very important. But yes, I agree. It is very exciting to see what is in store for 21-22.
I wanted to understand from you, according to you, what are the biggest risks that lie ahead for investors in 2021?
The risks are, if it is known, then it is not the risk. You imagine last year, nobody said on the TV or anywhere that virus will be the biggest risk. So if you ask me, the biggest risk is not being in the market right now, not being participating in the market. That would be the biggest risk of 2021, because there's a lot of fear around. I can see, at least among our clients and our friends, there's a lot of skepticism, and they are selling out of the market. I don't know whether it is very tough to say who's right or who's wrong, but I think the biggest risk in the equity markets is not participating right now, because we have seen the worst of the economic or health disaster, and yet we have done 15%. So 2021 hopefully will not repeat the 20, and I think we should have at least 15% as good a year as 2020 on the whole, and probably it could be a reverse V kind of a shot. I mean, like 2020 was the shot was the V. We went down and then we came up, and in 2021 it will be just the reverse V. So that's the risk of not participating on this exciting journey.
Okay. So, the team and Motilal Oswal has always been very bullish on the whole rural play. And it's not just some of the FMCG names, but even the auto names. As we speak, some of these names like Escorts are doing really well, reporting cracker numbers in the month of December. Do you think there's still a lot more to go? Are we at the start of some sort of an upcycle in some of these rural plays?
Yeah, I mean, see, one of the things is that we had a bumper monsoon in last 2 years, and we are benefiting from the current year's good monsoon and moisture levels. And second is the low interest rates across, high liquidity, and general rural prosperity because of various prime ministers' initiative to pump subsidies and supports to various segments of farmers, I think there is a lot of prosperity in rural India, and they have also not suffered from COVID. So I think the confidence in the rural economy is very high, and hence rural prosperity is there. So all kinds of cheap, entry-level bikes or tractors and fertilizers, crop protection. So all sorts of things are doing well, and the moment it is supported by their bigger brother, urban India, which should happen in the second quarter or third quarter of this year. I think we should see synchronized pickup in the demand for all the products which are actually rural centric.
Okay. Ramdev, will you pick up any of the unlocked trades? Specialty restaurants, and now, of course, even Jubilant has bought Barbecue Nation 10%. I mean, any of them, airlines, hotels, any of them?
Yeah, so some of the industries had a particularly bad fortune or misfortune in pandemic. That doesn't prove any business a bad business. Just because the businesses are closed for 12 months or 18 months because of misfortune, I don't think those businesses are to be termed as a bad businesses. So I think there is actually a great opportunity in looking at some of these great businesses, franchises, which have suffered some kind of a loss of output or sales for 3-4 months. I think they will make a huge comeback, because what it would do is that setback has really allowed them to cut the cost in various ways. And when the demand comes back, they'll be lean and much more ready to grab. And another thing which has happened in this pandemic is that there's a lot of consolidation. It's almost like a K-shaped kind of recovery, where one third or 50% of the people, smaller outfits, have not done well, or they are finding it difficult to recover. Whereas the big ones, well consolidated, prepared guys, they are able to grab market share. So you will have a much more vigorous recovery in the successful companies, though they were impacted by pandemic. So yes, I think some of the companies will definitely pick up.
You know, the other day, your colleague Gautam Dugar made a very interesting point. When I asked him what will be your unlocked trades, he said financials actually, because they are, so much economy dependent. Now, we were just running your portfolio. You have all the HDFC guys in your portfolio. Will you stick with this variety of the HDFCs and the Kotaks, or do you think it's time to go down the mid-cap banks, small-cap banks, small finance banks?
Yeah. So, Lata, I think as far as my recommendation would be that lenders are the most vulnerable in these kind of situations. I mean, countries like India, they're impacted by various things. Apart from pandemic, the global forces, weather, and a whole lot of things. So we have to back the companies which have a very good lending track record. And the stress test, the mother of all the stress test was the COVID period. Like last year was the worst, most stringent test for lenders. So those who survived and those who actually came out clean and stronger, I think those are the ones where we should back in. I can buy a very bad, I can buy a second-rate steel or cement company, but not a second-rate lender. So one has to be very careful, particularly as an investment. As a trade, as a momentum trade, I think rising tide will lift all the boats. So I'm sure the small bank, PSU banks, even not so well private sector banks, everything will go up in this environment. But if you really want to invest and have a peaceful evening, I think it is important to buy quality names.
Okay, I think that's the buzzword, right? Have a peaceful evening or a peaceful night's sleep with your investments after all that we've been through. So, there are so many new investors who made fresh demat accounts during this lockdown period, and we keep getting requests as to what they should be doing in 2021. In 2020, if you had invested in mid-caps and small-cap funds, you would have made the most amount of money. Do you see that same trend continue in 2021? Would you prefer mid-cap, small-cap funds compared to large caps, or do you think the trend will change?
I don't know about the trend. Trend is going to be your friend, but what I'm saying is that the FIs are a clear preference for the large caps because they want to deploy a lot of money very quickly, and hence they have been buying all the large caps. And clearly, the DIIs or domestic investors, they have been net sellers. and that money is clearly rolling into mid and small caps. So clearly that's the trade on, and most likely this trade is going to continue for at least for some more time till economic recovery is very clearly visible. When economic recovery comes back, what will happen is that even the domestics will want to buy the large caps. At that point of time, I think if both the segments want to buy large caps, there will be a complete flare up in the large cap again. So I think what is the message is that I would buy quality growth companies, irrespective of whether they are small cap, mid cap, or large cap, and build a portfolio of kind of a multi cap. And because these are changing what do you call that? It's a wind which is changing directions every month, every quarter. So what is important is that you should be well placed. Let the fund manager decide where exactly the next spot where the wind is going to change, and hence multi-cap would be the best kind of a bet.
No, I agree with you. I always prefer giving the fund manager full freedom, so multi-cap is always advisable. Ramdev, it's a pleasure having you with us as always. Thank you very much for joining us on the first day of the new year, and may you have a peaceful and prosperous, a healthy and happy 2021.